So hi guys, this is SJ speaking, and in today's video let's see about what is market stabilization scheme. So before going to the video, I'm personally teaching trading. So if you want to join my mentorship course, you can contact me from the number which I've given in the scoring on my video below. So I'm totally taking 7 courses. So if you're interested, you can enroll any one of the 7 courses. So now let's go into the video. So market stabilization scheme. So this is one of the monetary policy tools which comes under the quantitative tools and non-conventional category. So you can see here market stabilization scheme. So let's see about this. And before seeing about the market stabilization scheme, there is a concept known as sterilization. So what is sterilization? It is a monetary action taken by the RBI to control the excess money supply created by it when trying to stabilize the Indian rupee. For implementing sterilization, the RBI uses market stabilization scheme by issuing market stabilization bonds. So I will explain what is this exactly. So usually the foreign currencies come into the Indian economy. How they are coming? For example, so if someone is exporting goods to, for example, US, the US bring the dollars into the Indian economy, and they have to pay in Indian rupees if they are buying goods from us. So they exchange the US dollars for Indian rupees and pay with the Indian rupee to us. So this is how the dollar inflow comes into the Indian market. This is one way. There's another scenario. Let's take. There are many different ways where foreign currencies come into Indian economy. For example, so exports is one of the way, and foreign direct investment and foreign portfolio investment or remittances. So from so some persons would have gone from India and they are doing a job in US and they are sending amount to India. So that is known as remittances. So these 4 ways are in which a foreign currency comes into the Indian economy. So now let's see. I have explained about exports. Now let's see about the FPI. So foreign portfolio investment. Let's take this as an example. So, foreign portfolio investment means, let's take for example, one of the institutional investors. In case of India, there are mutual funds, pension funds. So, these are known as institutional investors. So, let's take mutual funds. What they do, they take the money from the common people like us and they invest in stock market. And after they divide the profits and give it to the people who have invested in the mutual funds. That's what they do. In foreign countries also, they do the same procedures. But where they are investing, they can also invest in foreign stock market also. Foreign countries stock market also they can invest. Suppose a US foreign institutional investor, suppose he can also invest in India. So if some US investor, foreign institutional investor is trying to invest in India means, so he have to exchange his US dollars into rupees and then he has to he has to exchange the US dollars into Indian rupees and he must invest that Indian rupees into the Indian stock market. For that, he's bringing dollars into the economy and he's exchanging it for the rupees. But usually the banks are having the rupees, Indian rupees, for giving out the Indian rupees as loans to the domestic companies. So the domestic companies usually come and ask loans. So the banks keep the Indian rupees for giving the loans to the domestic companies. But since a foreigner comes, what the foreigner says, I will pay you more dollars for getting the Indian rupees. So you give it to me. So what the banks will do, they will give at higher they will increase the price. So what happens? The higher dollars are given to buy the Indian rupees. So in this case, what happens? Since the demand for the Indian rupees is increasing due to the foreigners, the Indian currency appreciates in value. So the dollar depreciates in value. So the value of the Indian currency increases. So it is good, no? If the value of the Indian currency increases, it is good, you might think. So, but the RBI wants to avoid this. Why? Because you might wonder why the RBI wants to avoid this. The currency is appreciating and it's good for you. But here is the fact. Even if the currency appreciates, it is one way negative for us. So I will explain. Let's take import and export. So there are 2 scenarios. One scenario, the US dollar appreciate and INR is depreciating, and in another scenario is US dollar depreciate and INR is appreciating. So if our INR depreciate means what happens? For suppose $1 is equal to 80 rupees means if we are exporting from USA, if you are buying products, if you are buying a laptop from USA, it will cost you more money. So for example, now let's take for example $1 is 80 rupees. If our Indian rupee depreciates and $1 is equal to 90 rupees means if you are buying goods worth of $10 from USA means before depreciating it is 800, but after depreciating it is 900 for you. So imports become costlier when our domestic country, that is Indian rupee, depreciate means. But for exporters, they get more income when our domestic Indian rupee depreciate means. If someone is exporting from India to US means, if the Indian dollar depreciate means, it is good for them because their export income increases. For example, if I am exporting to US $10 worth of good means, when 80 rupees means I will get 800 rupees as income. But if my if dollar appreciate and Indian rupee depreciate means I will get 900 rupees as my income. So exporters it is good, but for importers it is bad. If you are importing means this is bad. So one positive, one negative. So similarly, in case of appreciation, what happens? So $1 is equal to 80 rupees. If $1 becomes 70 rupees means if I'm importing something worth of $10 means I have to pay only less rupees. For 700 rupees itself, I will get goods worth of $10 from USA. But if I'm exporting means, if I'm exporting $10 worth to USA means I will only get 700 rupees as income. So if our Indian rupee appreciate means, so 10 rupees is appreciated. So I will be getting less income if I'm exporting. So for importers it is good and for exporters it is bad. So one way is for positive and negative in both the cases, in case of appreciation and depreciation. So what the RBI will do, it will try to stabilize the Indian rupee. It will try to keep the Indian rupee from being unchanged. So it will try to maintain the Indian rupee at 80 rupees. So it will not be bad for both the importers and exporters. For this, what it will do? So now let's come into the previous case. So FPI investors asking for the Indian rupees. So demand for Indian rupees is increasing. So demand for Indian rupees is increasing, and so the currency appreciates. So in order to stabilize the Indian rupees, what the RBI will do? It will sell the Indian rupees in the open market. It will start selling the Indian rupees in the open market. So how much demand is increasing? The supply is scattered according to the demand. So supply is also increased. The RBI releases more Indian rupees into the open economy. So what happens? So the price of the Indian rupee increases only because the banks are giving the banks are saying what I have to give to the domestic companies as loans, but you are asking why I should give to you. So the foreigner says I will pay you more. So that is what is happening. But if the rupee is available more in the open market, automatically the prices of the rupee come down. So the Indian rupee is stabilized to $80. So this is what RBI achieves. But what the RBI did, it increased the money supply of the Indian rupees. But what happens? Suppose the FPI, the foreign portfolio investment, is the short-term investment. Is only investing for 1 month in the Indian stocks. After 1 month, the Indian stocks appreciated in value, and he took the money out from the stock market and he exchanged it for the dollars and he took to the US. So only for 1 month he was there, and again he took the money and went out of the market. But the money supply which was received by the RBI, it is still in the market. So it will cause inflation. Still it is in the market. So it is extra. So since the money supply is more, it leads to inflation. So more number of people will have money in their hands, it will lead to demand of the products, it will lead to inflation. So what the RBI does, so this is what the sterilization concepts will come. Sterilization is the monetary action taken by the RBI to control the excess money supply created by it while trying to stabilize the Indian rupee. So the liquidity which was injected into the economy while trying to stabilize the Indian rupee, now the RBI injected the liquidity while trying to stabilize the Indian rupee. Now that the liquidity which it has injected, it must again observe it. Then it must observe the injected liquidity. So injected liquidity must be observed by the RBI itself again. So that is what is known as sterilization. And for implementing the sterilization, the RBI uses this market stabilization scheme. How it does this MSS? It does this by issuing some bonds known as market stabilization bonds. So usually the RBI will ask the government to allocate the MSS. So according to it, on behalf of the government, the RBI will issue the MSB bond. That is under the MSS, some T-bills and cash management bills are issued. So and then issued to the banks, and the liquidity is observed, and this is known as MSB bonds. MSB. That is market stabilization bonds. So now you might wonder if the government MSB bonds are released into the economy and liquidity is observed, the government are getting the funds. What if the government uses those funds and using for some project like building a highway or something? Then again, employment opportunities will be given by some company who is constructing the highway. Then money supply will also increase in the economy. You might wonder, no, the government can't use these funds for expenditures. So the government will have a separate account with the RBI, and the funds are going into that account, and the RBI holds those funds which are observed. So by issuing the MSB bonds, the RBI holds them, and the interest is paid by the government. Usually, the interest rate paid by the government for issuing bonds under the MSS will usually be high than any other bonds which are issued. That is why it is attractive for the banks to give their money with the under the MSS process. So this was taking place. For example, if government is observing, for the RBI is observing 30,000 crore by issuing some bonds using the MSS means. So this MSS allocation is done by the government. The government is allocating the how much RBI can observe by issuing the MSS bonds. Government is keeping the allocation. So it is also known as MSS ceiling. Sometimes the ceiling can be increased. During the demonetization process, this ceiling was increased to around 6 crore. Because during that demonetization, the bank had several liquidity. So usually we went and deposited all our cash into the bank during the demonetization on 2016, and banks had huge liquidity. What if the banks gave this money as loans to the companies? It will further increase the money supply. In order to avoid this, in order to observe this liquidity, what the RBI did, it issued the government securities and it observed the liquidity under the reverse repo process. But since several lakh crores was with the bank, the RBI did not have that much amount of government securities. So the RBI can't take out all the liquidity from the banks by using the reverse repo. So that is why the SDF came into process. So standing deposit facility. Under this process, the RBI need not give the government securities to the banks. It can simply, the banks can park their liquidity and the RBI will pay interest to them. So that is what the difference between reverse repo, and that is why the reverse repo was replaced in the liquidity adjustment facility corridor by SDF. So another scenario, CRR was also implemented. Incremental CRR was implemented. So CRR was increased, but the banks had no use when increasing the CRR during the demonetization, because the RBI will not pay any interest. So but if the MSS ceiling was increased, so if the bonds were issued under the MSS to the banks, the government pays some interest to the banks, so it will be useful for the banks. So the banks usually will give their funds happily to the government, to the RBI under the MSS. So that is this is the concept of the MSS. So what is sterilization? So in order to stabilize the Indian rupee, the RBI injected some money supply. So it increased the supply of the Indian rupees in the economy. So after the foreigner went out of the market, the injected liquidity must be observed. So observing the injected liquidity, that process is known as sterilization. In order to implement sterilization, it is done using for implementing sterilization, it is done using the market stabilization scheme. How the MSS is, RBI uses the MSS means by issuing the market stabilization bonds. That is either some T-bills or cash management bills are issued under the MSS process. So those bonds are known as MSB, that is market stabilization bonds. So hope you got a good clarification, and if you enjoyed the video, thumbs up, and like my video, share it with your friends and family, and subscribe, and also press the bell icon to get notified for all my upcoming videos. If you want to open a Demat account and trading account, so I have given you Zerodha link, Alice Blue link on all my YouTube videos description. Other than that, if you want to learn trading from me, if you want to join my mentorship course, you can contact me from the number which I have given in the scrolling below on my video. I'm totally taking 7 courses. It will be very useful for you guys. So thank you guys. I'll see you on my next video. Until then, bye bye. Take care.